Hello and welcome to Future Generation Investment Insights. I'm delighted to have Jun Bei Liu here from Tribeca Asset Management with me today. Jun Bei Liu manages 3% of Future Generation Australia, and she's done that for, Tribeca's been involved with us for a number of years. But more importantly, you manage the funds for us pro bono, which is incredibly important because we give that 1% to those not-for-profit. So your work is incredibly important to us, so thank you. You're over $1 billion now in terms of management of what you're managing. And that's really pretty amazing, especially now in these volatile times. I mean, how's your fund holding up?
Look, thank you. First of all, thank you so much. And I always feel such an honor to be part of the Future Generation managers and Future Generations family, really. And I always feel so happy to be able to give back to the society and knowing where those dollars are going to. And then, all the charities that you represent, which has been phenomenal. Look, surely it's a very volatile market. Actually, I look at our performance, given we're a long-short fund, we're actually done quite well so far this year, as well as, so far this financial year, this September quarter, we actually deliver over 2%, 2.2% to be exact for our investors, compared to a market has been up and down, pretty much flattish at this point. Look, it's a very tough environment at this point, for fund managers like us, because we long short, so sometimes investors are a little bit confused what short is. It's to bet on the share price falling. So this is really our market. To be an investor over 20 years experience, I get very excited in this sort of market because we find so many opportunities. You always see me getting very excited talking about stocks, and this market is fantastic. We just, every few days, we find those high quality businesses just being sold off. And we, fortunate enough to be a long-short manager, active manager, we can actually, buy some of those businesses. And a lot of them are probably as cheap as they were during the onset of pandemic. So, it's volatile markets, but it really a great market for picking up great companies.
With the IMF, they've just downgraded in terms of their growth outlook, and they've warned that it's going to be a recession for many millions of people. So it is tough out there, especially globally. You've got central banks, they're sort of raising rates. You've got inflation even, and you've also got a number of markets now in that bear territory. What do you think the temperature is like in Australia? And then maybe afterwards, if you think about how ring-fenced we are from all of that global uncertainty.
Look, Australia is better positioned on that basis. So let's look at some of the uncertainties and risks. So other markets, they have got really rampant inflation. The inflation hitting high single digit. Australia is somewhat more benign, still in that mid-single digit level. It's partly because our labour market is structurally different because of the awards and unionised sort of space. It takes longer to come through. And two is that some markets really have hitting those energy crises. So like the European market, where they get a lot of their energy come from Russia and sanctions, and there's so much disruptive forces is really forcing those markets into crisis. And also if you look at the interest rate increases, in the US, they've gone up a lot. We have really just started some of those paths, but nothing nearly as much as that. And if you look at UK, they've gone through the crisis of their pound collapsing, and also that is the economy. Don't forget they're managing Brexit as well. So it is an economy is going through many challenges. So Australia's better position. Our corporates earnings, in a way, because of the lockdown, in a way that we still yet to return to the pre-COVID level. So our corporate is still recovering from the lockdown. Believe it or not, 6 months ago, big part of Australia is still in lockdown. Now everyone's flying. So, corporate earnings is still yet to recover. So we still have some earnings growth compared to the other markets. So we will grow better. And the Australian market, of course, is more dominated with, the financials, the resources. And both of these should do reasonably okay during an environment where there's a bit of inflation, high interest rate. It should cushion our community, our economy much better. China is a little bit tough at this point, but we do think that they will reopen the economy by early next year, and this probably means the commodity prices will be reasonably supported, which means our economy in terms of demand for our products will continue to be pretty good. So we look pretty good, and we're very cheap in terms of scheme of things relative to globally. That's why we've been such an outperformer globally so far this year, and we continue to be doing doing so. You look at NASDAQ hitting bear market and all of that, our market is flat. So we actually have performed very well. We continue to see our market will do reasonably well. Obviously, there's a lot of uncertainties and variables, but this is the market that I do see some sort of earnings growth coming through.
Oh, that's actually really positive to hear. So in terms of your outlook for that sort of 1, 3 and 5 years, are you changing your portfolio a lot now to position for that, or are you just doing it slowly over time, or when you see those opportunities?
Yeah, I'm probably the latter, the last one. I'm more opportunity driven. Every investment we make, we always work out what's our estimated expected return. If it meets our hurdle, we will then take positions. So right now, because there's been so much sell-off across some of the growth and quality leaders, and to us, these are structural businesses, structural growth businesses. They will future-proof your portfolio, whether they're healthcare, whether they're some tech, or whether they're in the staple business, or whether they listing businesses. These are businesses we expect to grow over the next 5 years to be much, much larger than they are today. So short-term earning might be a bit volatility because of cyclical and things, but we do think this is the opportunity to pick them up. So right now, portfolio certainly is gradually moving towards those companies simply because their share price just becoming unsustainably low. Any of those businesses, my view is that if any of those businesses continue to stay at this price for the next 6 months, they will all become private.
So you mentioned China. I mean, obviously there's a lot of geopolitical risk out there. How do you think that's going to impact Australia? I mean, obviously I don't want you to comment on the politics of the situation with our government, but what are the long-term consequences or perhaps opportunities in the long term?
Of course, look, we definitely have gone through a rough patch, but we always, while it's harder to call, the political direction and whose relationship and who's visiting who, I would just take a step back, looking at China's relationship with its own neighbors, over the last 3 decades, right? So, look at China's relationship with Japan, China's relationship with South Korea. Look, they have fights over time, from periods of time, 2-3 years. And then you look at the trade between China and those countries. They've been growing stronger ever since. So, to me, it is a short-term, it would seem it's a short-term blip. We have differences and then over time, hopefully we'll be like those neighbors, that China with those neighbors, that will get over our differences. Certainly, currently it does seem like publicly the news exchange that I have read is that relationship seems to be thawing. And we do hope that, improvement from here, which will mean greater opportunities for our businesses, and potentially some of the harsh tariff can be removed. It's all great for our businesses, our economy, and our consumer ultimately.
I think it's really important. I think many are really hopeful that relationship is going to improve. So for you, what are the most promising sectors in Australia at the moment and why?
Look, with all the macro uncertainty and backdrop we just talked about, I will absolutely put my focus on healthcare sector. A couple of reasons. First of all, healthcare's earnings, healthcare sector is one of the most defensive earnings space. They will grow with or without recession, or regardless of economic activity. And also on top of it, quite a lot of the healthcare businesses whose earning has been impacted enormously by the COVID. You would thought healthcare business benefit enormously from a global pandemic, but which it turned out they didn't. Many of them didn't. So the likes of CSL, because of their collection center was shut, and there's all the earnings, and these are actually just on the way back up. So even the pandemic recovery alone will give them high single-digit growth, and on top of that, you have your double-digit sort of demand 5 year out. So this is a business that will grow double-digit and with a very reasonable valuation, because market at the moment is just a bit fearful about buying anything at the moment. So that's your great opportunity. Another great one we really love is Ramsay Healthcare. We thought private equity clearly has sort of messed up the share price, but now the share price is way below what the private equity bid was. And this is one business I do believe in the next 6 months, if it's still at the current share price, it certainly will be sold to another player. So it's just very high quality business that would generate earnings growth and without in a very defensive way.
So obviously in terms of with your fund, the Alpha Plus, it's long short. What are you looking at in terms of your short positions? What sector are you looking there?
Absolutely. So we tend to follow the earnings, and right now the sector that seem more vulnerable to earnings downgrade is really the consumer sector, whether it's staple or consumer discretionary. Consumer sector, over the last 8 months, I would say, has experienced still continued pretty buoyant conditions, but just more recent times we're started seeing some of the cracks appearing, not only across the US market, in the Australian market we started seeing some of that as well. Just more recently, we've seen downgrade from a couple of retailers. Baby Bunting talked to a sharp slowdown, really. It could be just consumers started pulling back on some of the spend, not collapsing, just started pulling back some of the spending, and they need to pay for that overseas trip that that everyone has booked. So all of that together, we do have a few shorts in this space, really just to gain exposure to potentially weaker earnings coming through over the next 12 months.
Thank you. Our shareholders love stock picks. So if you could possibly give us one, that would be fabulous, but long term.
So one I touched on before, I think this one is absolutely, I will put my mother's money in, is Ramsay. This is a premium private hospital chain, largest in Australia, have a lot of high quality assets, those private hospital assets sitting on the balance sheet. And also it's also got operations in UK and in France. The earnings has been impacted because of pandemic lockdown. Elective surgery was not able to operate at full capacity, but that's coming back. We're seeing the waiting list in the public hospital now up to 2 years long now. It's just a matter of time before people return. And it will have double digits earnings growth, very stable, strong franchise. And the share price is one of the very few that hasn't really recovered to the pre-COVID levels. So to us, this is one company that you can just buy and put in the bottom drawer.
Excellent, thank you. Well, my final question is, why is managing future generations' money important to you?
Look, I think it's so incredibly important. As fund managers, we manage investment and we're generating return for our investors. We feel, very happy about it, and that our investors can have a better lifestyle and things. But for future generations, there's additional bonus, if you like, on the side, is that we can actually see that that money to be donated into different charity, and then by learning more about those charities, you really see how how much impact we could have by doing what I love every single day. I myself is very involved with one of your charity, which is Raise Foundation. And we can see for every $2,000 they raise, and they can find one kid to find a mentor. So to me, that's very, very incredibly rewarding to be able to see that, and to be able to help.
Well, thank you very much. We find it incredibly rewarding as well as our shareholders. But thank you very much for managing our money pro bono. So Jun Bei Liu from Tribeca Asset Management. Thank you.
Thank you so much for having me, and it's such an honor to be part of your group. Thank you.
Thank you.